Today, we are digging into a fascinating financial report that takes a deep dive into the Asian markets, and what it found is a story of two completely different signals, both flashing red hot at the exact same time. It's a real head-scratcher. So, let's start with this. Today, February 19th, 2026, this was the number everyone was talking about, a massive 3.09% surge for the KOSP, smashing through to an all-time record high. On the surface, it's pure celebration. It looks like incredible market strength.
But on the very same day, this was the other number. Foreign investors, they sold off nearly 1 trillion won worth of stock. It's like while the party was just getting started, the so-called smart money was already quietly heading for the exits.
So you've got a record high on one hand and a massive sell-off on the other. These two things just don't add up. They completely contradict each other. This right here is the central mystery we're going to unpack, using the data and the analysis from the source report.
All right, so here's how we're going to break this all down. First, we'll dig into the mystery of today's market. Then we'll look at 6 theoretical warnings hiding behind this surge. After that, we'll see what the raw numbers are telling us, which leads into the report's big forecast of a great capital migration. And finally, we'll look at the specific quant strategy it lays out.
So first up, let's look underneath those big, celebratory headlines. What clues did the market action on February 19th leave behind that maybe point to a completely different story?
Okay, now this is where it gets really interesting. Look at the export data. At first glance, the numbers look incredible, right? But that growth is dangerously concentrated. Semiconductor exports have more than doubled, all driven by this AI boom. But look at cars and machinery. They're down double digits. This isn't a broad, healthy recovery. The report calls it a K-shaped recovery, where one part of the economy shoots for the moon while the rest falls away. And here's another major disconnect. The Bank of Korea is holding its official rate steady at 2.5%, but the actual interest rates people and businesses are paying for new loans, they've surged past 4%. This rising cost of borrowing is putting this hidden, immense pressure on anyone using debt to invest, and it's creating a real fragility just beneath the surface.
Now, what's so important to understand here is that these aren't just random warning signs. They actually fit perfectly into some well-established economic theories. Let's see how some classic frameworks interpret what's happening right now.
So the report first points to this idea of herd behavior. The basic concept is that the market is no longer acting rationally. Instead, it's being driven purely by emotion. You get the stampede of investors piling into a single dominant story, in this case, the AI supercycle, without really looking at the fundamentals weakening everywhere else.
And then you've got this classic concept, mean reversion. History shows time and time again that what goes up, especially when it goes up this vertically and this fast, eventually has to come back down to its long-term average. A chart that looks like a rocket launch is, according to all the historical data, just fundamentally unsustainable.
And this slide just illustrates the whole conflict perfectly. The noise is the retail crowd, right? They're cheering the 3% jump, taking on expensive debt to buy more at the absolute peak. But the signal? That's the quiet action of foreign institutions, selling almost 1 trillion won of stock to lock in their profits. They are selling exactly what the retail crowd is buying.
Okay, so let's move on. Let's strip away the theories and the emotion for a minute and just look at the language of quantitative models. The report runs the data through several of them, and, well, the results are pretty striking.
This first model, GARCH, is all about measuring volatility, and the key number it spit out was 0.985. So what does that even mean? Well, anything close to 1.0 suggests the market has become incredibly fragile. The effect of any future shock, good or bad, isn't going to fade away. It's going to be amplified, leading to explosive price swings. The market is basically a tinderbox waiting for a match.
Next up, the VCM model. This one basically compares the current stock price to its fair value, based on all the economic fundamentals. And the result? The report finds the KOSPI is overvalued by at least 10%. Think of it like a stretched rubber band. This model is suggesting a powerful snapback to reality is coming.
And if that wasn't clear enough, the report ran a simulation of 100,000 different scenarios for where the market could go next. The results are just stark. There's only a 14% chance the rally continues, but a nearly 68% probability that the index falls, and falls significantly. Statistically, a drop is almost 5 times more likely than a continued rise.
And finally, the report just confirms all this with classic technical indicators. The RSI is screaming overbought. Think of a sprinter who's just run too far, too fast. The MACD is showing that upward price momentum is fading. But the most critical red flag here is the OBV, on-balance volume. The price made a new record, but the volume, the energy behind that move, just didn't keep up. This suggests the big institutions are quietly selling their shares to an eager public. It's a classic sign of distribution.
So you put all of this evidence together, the case-shaped recovery, the economic theories, the quant models, and the report makes this one bold forecast. We are on the verge of what it calls a great capital migration. The first part of this migration is capital flowing out of South Korea. The analysis projects a pretty significant correction by the end of next month, March 2026, with the major indices falling somewhere between 7 and 10% as the market snaps back to its fair value.
So where does all that money go? Well, the report predicts it will flow into the relatively undervalued markets in China and Hong Kong. With lower valuations and signs of government stimulus picking up, these markets are forecast to see some modest but steady gains as they become the new destination for all that migrating capital.
So based on this whole forecast, the report finishes up by outlining a very specific quantitative strategy designed to navigate this exact scenario. And I just have to state clearly, this is just a description of the report's findings. It's not any kind of direct financial advice.
The logic behind the strategy is explained with a really simple analogy, the water bucket theory. Think of the Korean market as a full bucket, one that's about to overflow. And the Hong Kong and China markets, they're the nearby, relatively empty buckets. So the strategy isn't about betting on one bucket or the other, but on the process of water flowing from the full one to the empty one.
Here's how the report breaks that down. First, a short position on the KOSPI 200, which is basically a bet that the index will fall. Second, at the same time, a long position, a bet that it'll rise, in a Hong Kong tech ETF to capture that expected capital inflow. And third, a volatility hedge. You use a small bit of capital to buy options that would profit from a huge market move in either direction, kind of like insurance against that explosive volatility the Garch model predicted.
The report's final analysis is really all summed up in this one pretty powerful quote. It says, KOSPI 5,677 is less a celebration of growth and more a funeral dirge of a bubble. It's a stark, uncompromising conclusion based on their data.
And that really leaves us with the final question, doesn't it? The report argues that the quantitative data, the numbers, are sending a very clear warning signal through all the celebratory noise. The real question is, which one are investors listening to?